Hi, I'm Jim Elder, a director in our investment management segment at S&P Capital IQ. We are back again to discuss the key findings of our third issue of Fixed Income IQ. This is a quarterly publication produced by S&P Capital IQ that leverages comprehensive proprietary analytics and data to provide you with quarterly trends in the global fixed income markets. I'm here today with one of the authors, Jay Bankaria, a senior manager in the investment management segment. I'll start with market performance. As you can see here, the high yield markets have struggled in the third quarter after a strong first half. The S&P US High Yield Corporate Bond Index declined 1.74%, with the investment grade index basically flat. Europe fared a bit better, with the Barclays Capital Pan-European Corporate Aggregate up 2.57%, whereas the high yield markets in Europe fell by 0.11%. Overall, the European markets are performing better than the US, but both are significantly below first half performance, where European high yield rose 6% and US high yield rose 5.4%. This unsurprisingly aligns with the widely reported outflows from high yield funds globally, especially during July and August on renewed fears of rising interest rates. Jay, can you tell us what's happening in the new issue markets?
Yep, thanks, Jim. So in this new low rate, low default environment, over the last year, we've noticed a strong pickup in high yield issuance. The chart we'll see here now is year-over-year issuance change by ratings category. So one thing we do notice is that in US, we see the strongest issuance change in our single B ratings category, while in Europe, we observe the strongest change in double B. It's interesting that the US, we're seeing a stronger demand for a lower rated issuance, while in Europe, the demand is closer to more of an investment grade issuance. A couple names to note: in the US, the largest single B issuance has been HCA Holdings, while in Europe, the double B largest issuance has been VimpelCom.
Okay. Well, given this increased issuance, especially in the lower rated portions of the market, and especially in the US, what can you tell us about the type of debt that's coming to market?
Yep, there's been a big trend this year for covenant light deals coming to market. So what we wanted to do is take a look at some of our covenant data to see trends in actual specific covenants and see how that looked as a percentage of total issuance. So in the chart here, we can look at three specific covenants and see their yearly trends as a percentage of overall high yield. And one thing we do notice is that a strong decline in all of these covenants throughout the last year. So the reason for this is that as there is such a strong demand for these high yield bonds, as investors do search for more yield, we are noticing that issuers are in more control of the terms when they are bringing any new debt to market.
Interesting. It will be something we'll have to keep an eye on to see where the markets are going and if we're getting into a new cycle in the credit markets, given the rising interest rates that are forthcoming. In our latest edition of Fixed Income IQ, we cover this as well as more trends in the market, credit quality, and financial ratios across North America, Europe, Asia Pacific, and Latin America. So please download a copy, and we'll see you next quarter.